Most people believe money flows through visible channels: banks on street corners, interest rates on the news, and government budgets debated on television. But what if the real engine of prosperity and pressure operates mostly out of sight, shaping outcomes long before elections, recessions, or bailouts ever reach public awareness? Tonight's story begins with a question that unsettles that assumption. If the rules are fair and the system is open, why do gains consistently pull at the top while stress spreads everywhere else? To understand that mystery, we need to accept an uncomfortable premise. Modern American prosperity was not built solely through free markets competing on equal terms. It was engineered through a layered monetary network where access mattered more than effort, timing mattered more than talent, and proximity to liquidity determined who thrived and who struggled. This network did not emerge overnight, and it was not created by a single villain or secret cabal. It grew gradually, quietly, and legally, shaped by crises and justified by necessity. The story begins long before the digital age, back when the United States was still arguing over what money itself should be. In the early republic, power was fragmented, banks were local, and credit was scarce. Financial panics were frequent, wiping out fortunes and livelihoods alike. Each crisis reinforced a belief among elites that instability was the real enemy, even if the cure required centralizing control away from the public and toward institutions capable of acting decisively. That belief hardened, and in the early 20th century, after a series of devastating panics culminated in the crash of 1907. The lesson drawn by financiers and policymakers was not that speculation was dangerous, but that the system lacked a central backstop. Out of that fear emerged the Federal Reserve, presented as a stabilizing force that would smooth cycles and protect the broader economy. What was less emphasized was how this new structure privileged certain institutions with direct access to money creation. At first, the Federal Reserve's role appeared modest. It set discount rates, managed reserves, and acted as a lender of last resort. But even in these early years, a pattern emerged. Large banks with direct relationships to the Fed gained cheaper access to liquidity during stress, while smaller banks and the public relied on secondary channels. Stability improved, but so did asymmetry. Those closest to the source of money gained a structural advantage that compounded over time. The Great Depression marked the first major stress test of this system. As banks failed and unemployment soared, emergency measures expanded federal power over money and credit. Programs designed to save the economy also reshaped incentives. Surviving institutions grew larger, regulations favored scale, and implicit guarantees began to form. The idea that some firms were simply too important to fail quietly took root, altering risk behavior for decades to come. After World War II, the United States emerged as the world's financial anchor. The dollar became the global reserve currency, and American institutions gained unparalleled influence. Domestically, prosperity spread widely, reinforcing faith in the system. But beneath that surface, the monetary network was becoming more complex. Government debt markets expanded, financial intermediaries multiplied, and access to capital increasingly flowed through layers few citizens understood or could influence. The 1970s introduced a turning point. Inflation, oil shocks, and the collapse of the Bretton Woods system forced a rethinking of monetary policy. When the dollar was untethered from gold, money creation became more flexible and more abstract. This flexibility allowed rapid responses to crises, but it also severed psychological limits on debt and leverage. From this moment forward, monetary policy became a powerful, centralized lever shaping asset values across the entire economy. As deregulation accelerated in the 1980s and 1990s, finance grew not just larger but more interconnected. Investment banks, hedge funds, and shadow banking institutions flourished, often operating beyond traditional regulatory oversight. These entities learned to position themselves closest to liquidity pipelines, benefiting first from policy shifts and cheap credit. For those on the inside, volatility became opportunity. For those outside, it became uncertainty. This dynamic reached its most dramatic expression during the financial crisis of 2008. When the system cracked under excessive leverage and risk, the response was swift and unprecedented. Trillions of dollars were created to stabilize markets, rescue institutions, and prevent collapse. The official narrative emphasized saving the economy, but the mechanics revealed something deeper. The money flowed first to financial markets, then to corporations, and only later, if at all, to households. The cause-and effect was unmistakable. Asset prices rebounded quickly, enriching those who already owned stocks and real estate. Meanwhile, wages stagnated, debt burdens grew, and millions faced foreclosure or unemployment. The monetary network had done its job as designed. It preserved the system by protecting its core, even if that meant transferring pain outward. Prosperity for a few became pressure for many, not by accident, but by structure. In the years that followed, central bank interventions became normalized. Quantitative easing, once an emergency measure, turned into a standard tool. Interest rates hovered near zero, encouraging borrowing and inflating asset values. For investors and large firms, capital was abundant and cheap. For workers and savers, returns diminished, and the cost of living steadily rose. The gap widened, reinforced by policy choices that favored liquidity over labor. Technology did not disrupt this pattern, it accelerated it. High-frequency trading, algorithmic finance, and digital platforms allowed capital to move faster than ever. Those with resources to invest in technology gained further advantages, capturing micro-gains at scale. Meanwhile, everyday participants were told markets were more accessible than ever, even as structural barriers remained firmly in place. By the time the pandemic struck, the monetary network was primed for another shock. The response dwarfed even 2008. Trillions more were injected into markets, once again stabilizing asset prices at record speed. Stock indices soared while millions struggled to pay rent. This divergence was not a mystery to those who understood the system. It was the predictable outcome of how money enters the economy. Data tells the story starkly. Over the past decades, the share of wealth held by the top percentile has risen dramatically, while median wages adjusted for inflation have barely moved. Housing prices have far outpaced income growth, turning shelter into a speculative asset. Debt levels, public and private, have climbed relentlessly. These are not isolated trends, they are symptoms of the same underlying structure. Attempts to fix these imbalances often fail because they target symptoms rather than causes. Stimulus checks provide temporary relief but do not change access to capital. Regulatory tweaks add complexity without reducing concentration. Political debates focus on spending levels while ignoring money creation pathways. The hidden network remains intact, quietly shaping outcomes regardless of who holds office. What makes this system resilient is also what makes it dangerous. Its complexity obscures accountability. Decisions made by technocrats and institutions are framed as neutral or inevitable, even though they carry profound distributional consequences. Because the effects are delayed and indirect, public anger struggles to find a clear target, dissipating before meaningful reform can take hold. History suggests this pattern is not unique to our era. Concentrated monetary power has repeatedly produced cycles of boom, inequality, and backlash. Each time, reforms promise balance but often entrench new forms of privilege. The names change, the instruments evolve, but the underlying logic persists. Those closest to the source of money shape the future first. Today, new narratives are emerging around digital currencies, financial inclusion, and decentralization. Some promise to break the old model, while others risk replicating it in new forms. Without addressing how money is created and who receives it first, technological innovation alone may simply rearrange the hierarchy rather than dismantle it. The first takeaway is that monetary systems are not neutral. They embed values and priorities that determine winners and losers long before individual choices matter. Understanding this shifts the conversation from blame to structure. The second takeaway is that stability achieved through unequal access carries hidden costs, eroding trust and social cohesion over time. The third takeaway is that transparency without reform is insufficient, because knowing how the system works does not automatically change who benefits. The warning is subtle but urgent. Systems designed to protect themselves eventually test the patience of those they exclude. History shows that prolonged imbalance invites disruption, whether through political upheaval, economic crisis, or social fracture. Ignoring these signals does not preserve stability, it postpones reckoning. The open question is whether awareness can translate into meaningful change before pressure becomes unbearable. That depends on whether the public demands not just relief, but restructuring. It depends on whether policymakers are willing to examine the foundations of money itself, rather than endlessly adjusting the surface. If this story challenged your assumptions, share it with someone who still believes outcomes are random or purely merit-based. Subscribe for deeper explorations into the forces shaping our world, and stay curious. Understanding the hidden network is the first step toward deciding whether it should continue to operate as it does.